A stop loss is simply an order that we set to ensure that our trade will be closed if it goes against us more than a certain amount. The main takeaway from this video and the main point is that most traders make the mistake of setting a stop loss with a monetary value in mind. So setting the stop loss at the point which is the most that they're willing to lose for that trade, or something along those lines. What I want to convey is that a stop loss should be considered as the point at which you have been proven wrong. I think this is the best way to think about it, because the way that you should approach trading is that each trade is, in essence, a hypothesis. You think that a market is going to move in a certain direction, therefore you set up a trade in line with your hypothesis, and your stop loss should be set to close that trade at the point at which you have been proven wrong. There's also a lot of other things to bear in mind, and we'll go through a few examples in this video. So the first example is from Bitcoin, and it's actually just from last night. So last night, Bitcoin was trading right around here, 10,300-ish, and my hypothesis that my trade was based on was that this breakout here was the main direction of the move, and that this was simply a retest of this line. It doesn't matter if you don't understand exactly what I mean by that or why. The point is that my hypothesis was that the market was going to go down from here. So I entered a short trade, and then I asked myself the question, at what point would I be proven wrong? At what point am I willing to throw in the towel and say, okay, this trade does not work out, and close it? And this is very important in two different respects. The first one is that if you're proven wrong, or when you're proven wrong, you want to lose the minimum. So once you've been proven wrong, there's no point in hanging in there and losing more and more money. You should just close your trade and minimize your losses. The flip side is that you want to have a good idea of when you have been proven wrong somewhat definitively, because otherwise you may risk closing a good trade too early. So if we look at this example, if I'm going short here, a common mistake would be to place the stop loss too close. So in placing a stop loss, traders often look at the most recent highs. So a common stop loss might be just above these little wicks here. So let's say around 10,350, maybe 10,400, something like that. Another level you might look at is this or this. And this kind of range, I think, would definitely be too narrow, especially considering the volatile nature of Bitcoin. And you can kind of see that by considering this point. You may have easily had the same trade in mind that I was just discussing here, i.e. going short. And if you'd put your stop loss just above this level, it might have got hit by this next candle. So there's a good chance that if I go short here, there might be another candle that reaches right around here before going down. On the other hand, there's no point in me setting my stop loss way, way, way high, because by that point, it's already very clear that the short trade was a bad idea. So I think the optimal point in this example would be somewhere around this kind of level, because it's so the 10,500 level. And that is for a few reasons. One is that it is decisively above these highs, it is close to these previous highs, and it is also back inside this channel. And if the price manages to get back in the channel, that is quite a bullish sign. Like you can see here, for example, it might slip out, but once it's back in, it's usually on the rise again. So I might expect it to just bounce off here, but I think once we're in the 10,500-ish range, then you can be quite confident that your short was not a good trade. You also want to be considering this from a risk-reward point of view. So in this example, if you set your stop loss at 10,500 and you've entered the trade at around 10,300, then your potential loss, your maximum loss for the trade would be around 200 points. Your upside, on the other hand, depends on, again, your hypothesis, your short hypothesis. So are you trading because you think the price is going to reach this kind of level? Or are you trading because you believe that it's going to go even further? Whatever the case, you need to make sure that you have a good reason to believe that, and that your upside, which in the case of a short is on the downside, is a significant multiple of what you're risking. So if you're risking 200, you want to make sure that your profit can be at least, let's say, 600, 800, 1,000. In this example, with the benefit of hindsight, the most likely level was that it was going to bounce back off this downward channel. So around 9,600. So if I've entered at 10,300, my potential profit is 700 and my downside is 200. So this is a nice asymmetric bet, which is always what we're looking for. Your stop loss should also change depending on the volatility of the market that you're trading and the time frame that you're looking at. So in this example, you can see the time frame of each candle is 4 hours. So it's a pretty short time frame, and this is more day trading. Whereas if we look at this example from today, you can see that the hypothesis for the trade is based on about 2 years worth of price movement. These candles are weekly candles, and you can see here the breakout from this formation. So your trade hypothesis and your stop loss need to be looked at on the same time frame. So here, if you're trying to trade this breakout and you think that it's a valid breakout based on your technical analysis, you're expecting this to go upwards towards the 120 range or so. So at what point would you throw in the towel? At what point would you set your stop loss? There's not much point in setting it, let's say here or here, because you could well be right in your long trade, but still get taken out due to the minor fluctuations within the major trend. A sensible point might be around here, just before the breakout occurred, so around the 109.4 level, or maybe just below the previous weekly close, 108.2 if you want to be conservative. But anything much more than that, and you're just losing money because your trade has already been disproven. For example, there's no point in putting your stop loss down here. The time frame with which you look at a chart makes a very big difference. So if here we switch from the weekly view to the daily, we can still clearly see the breakout, but you might be more tempted to set your stop loss below today's candle, say here, And the further you zoom in, the less sense it makes, the harder it becomes to see the picture that you were actually trading. It really does depend on the view that you're taking and the leverage that you're using. There are many, many factors. But in this example, where we're trying to trade a breakout, the short-term fluctuations are often such that the price can come back down to retest the support level, which in this case, if it takes a few weeks to come back down, could easily be 109.2, 0.3. So if your stop loss was higher than that, you would be taken out, but the price might then hit this level and bounce back up as you had expected. And that's why you should have it at least below the support level. You could see this clearly in the previous Bitcoin example right here. If you had traded this breakout from this channel on the short side and you had set your stop loss too close, let's say here for example at 10,250, you would have been taken out by this retest of the resistance level. So you should always take into account the potential trajectories of the price and ask yourself, which ones would I be willing to tolerate and keep my trade open because it's still potentially correct, and which on the other hand would mean that my trade was wrong and should be closed. So let's say you do want to open that dollar-yen trade that we were talking about, long, and you want to set a trade which is $100 in value, and you want your stop loss to be around 109.5. This is very helpful in showing you the amount that you would lose at this particular stop loss level. But what you should be really focusing on is the rate. Now, at the moment, it's not letting us go any lower. You can actually adjust this later on. If you open this trade, you can then manually lower the stop loss, and the additionally required funds will be taken out of your available balance. But by default, this is set to 50%. So see, you're losing 50% of your trade size. So if you do want to set your stop loss at a lower level, and we had decided on 109.5, and you think this is too much money for you to lose, then don't set the stop loss higher, because then your trade no longer makes sense. Simply reduce the amount of the trade until you're happy with the stop loss. So if we reduce it down to 75, this might be a more acceptable amount to you. And this is just in relation to your total account. So it's a risk management consideration. But you should never look at the stop loss amount in isolation when trying to determine the optimum stop loss level, because that doesn't really make sense. So still, we can't reach the 109.5, and that's because of our leverage. Because you can see this is a different topic, but in just a few words, the higher your leverage, the tighter your stop loss is going to have to be, because your position is actually bigger. So if we reduce the leverage to 20, you'll see your position, your exposure go down from 2,250 to 1,500. And now your same loss has moved from occurring at 110 something to 109.3. So now we can actually set it to our desired 109.5. And you can see this would be the amount. If we want to manage the risk, we can go even lower. So maybe we want to do a 10x leverage, and now this is only 23% of the position as opposed to over 50% before. and you can see the amount has gone down. So maybe at this point you could actually increase the position and your loss would still be smaller than before. These leverage considerations can be a little bit complicated, but I will make another video about that specifically. It's out of the scope of this video, but I just wanted to touch on it because it can be a useful thing to do in order to reach the stop loss that you need. So remember, if the stop loss that you're trying to reach is lower than what you're currently allowed, then you should be decreasing your leverage. Finally, this may be an obvious remark, but do remember to always set a stop loss when you're trading. The higher your leverage, the more relevant this rule is. If you don't set a stop loss, you might end up losing a lot more than you had planned or than you had wanted. And more importantly, you're deviating from your trading strategy because you're still losing money even after your trade has been proven to be wrong. This is especially true with markets such as Bitcoin, where things can move very, very quickly. So you should just get in the habit of, when you place your trade, whether that be a market order or a limit order, make sure that you also set the stop loss at the same time. So as we're talking about setting stop losses, we can't not talk about moving stop losses. The main message should be, don't do it, because it's usually very unproductive, although there are some cases when it can be good. The main reason why you shouldn't be doing it is because as we discussed previously, when you open a trade, you should already have a well-defined plan, and you should have already accepted that if your level, your stop loss that you have carefully chosen gets hit, then that's fine. In fact, you should be happy that you are losing what you have considered to be the minimum for that trade, and you don't want to waste a single more dollar on it. Psychologically though, it can be tricky, especially if you're watching the price move and you see it approaching your stop loss. It can be very tempting to just move it a little bit further down and a little bit further down, but then before you know it, you're just adding more and more money to a trade that has already gone bad, and that doesn't really make sense. So the general rule should be, never move a stop loss downwards, and knowing that you've carefully chosen that stop loss in the first place for a reason helps you have the confidence to not move it. One of the keys to being a consistently profitable trader is to cut your losses short and let your winners run. You need to try and remove emotions as much as possible from trading, especially related to losses. They're going to happen, they're inevitable, and in fact, you should expect to have a high frequency of small losses, but they will be hugely outweighed by a minority of very big gains. The only real time that you want to be moving a stop loss is when you're effectively using it as a take profit on the downside. So let's take this Bitcoin trade as an example. As I mentioned, I entered the trade around here and I went short. So at this point, as the trade has moved significantly in my favor, what I'm trying to achieve is a balance between protecting the profits that I've already made, but also not putting a stop loss that is too tight and therefore doesn't allow my profits to keep on running. So as you can see here, if at this point I had set a stop loss around here, I would have already been taken out and I would have just sacrificed this amount of profits. On the other hand, if I set it way, way, way up here, then maybe I'm giving away too many of my profits. What a lot of people tend to do is they will, when a trade has moved significantly in their favor, they will move their stop loss to their entry price. So they will move their stop loss from where it initially was, so in the case of this trade around 10,500, to the point where they entered the trade, 10,300 and something. The reason for this is mostly psychological, because it puts you in a position where you feel like you can only make money or break even, and so nothing bad can happen. But the money that you have made from this trade already going in your favor is already yours, and you should treat it as such. You should protect it just the same way that you protect the money that is already sitting realized in your account. So you really need to be asking the same question as when you initially set your stop loss. At what point of price retracement are you going to accept that this trade is now moving back against you, and therefore you want to bank the profits that you can? In this example, it's probably somewhere around this kind of level. So you can see there's a lot of movement and a lot of reversals in this price range. And so if it breaks above that, there's a good chance that it might be heading back up again. So let's take a look at my actual trade. So here you can see I opened this trade at an entry price of 10,311.5, and the mark price, so the current price, is just above 9,700. So considering the leverage that I used, which was very high because it was just a short-term trade, we're currently up by about 300%. As I said, I had initially set my stop to about 10,500, but I've now moved it to 10,011. So 10,011, if we take a look at the chart, is just above this resistance level that I had pointed out, but I decided for an extra safety net just above the 10,000 point. Just above 10,000. And the reason for this is that it's a very important psychological level. So if we do breach it, we're probably going to be going much higher, but often it's a tough level to penetrate. You can see it's been tested many times in the past, and it often bounces back off it. If you're still learning how to trade and you want to follow someone who can guide you and teach you, you can join the nearly 500 people that are following me with close to $1 million. Last year I had a return of nearly 49%, and this year in 2020 we're already up 17%, as you can see, 6.7% in January and currently around 10% in February. You'll be able to see my entire portfolio, all my trades, and even set your account to copy all of my trades totally automatically.